Alright, so let's continue with our discussion of beta. Beta is a difficult concept. Takes a little bit of practice to get into it. Hopefully you read some about beta to get some preparation for this discussion. But so beta is part of the capital asset pricing model. We already saw that formula. It is a single factor model. So since the creator of the capital asset pricing model, William Sharpe, essentially what he's trying to do is capture risk as simply and as straightforwardly as possible with just one factor, and that factor being the market, the stock market itself. How do stocks react in relation to the overall stock market? And so here's the really key to his findings of what won him the Nobel Prize in economics is there are two types of risk. There are systematic risk or systemic risk, and there are unsystematic risk. Systemic risk are those that come from the overall market, from the system. Systematic risk can be things like, are we going into a recession? Interest rates change, inflation, there's issues with inflation, commodity prices change. The coronavirus would be a systematic risk. It's something that affects all companies. It may not affect them equally. Some firms may be more harmed than others, but all firms are somehow impacted when interest rates change or whether we have a recession or a recovery. We refer to these also as non-diversifiable risks because you can't eliminate them by simply buying more stocks in your portfolio. Since every company has exposure to systematic risk, the only way to manage systematic risk is to buy companies with higher levels or lower levels of systematic risk. And that's where we're getting this topic of cyclical versus defensive stocks. So they're non-diversifiable risk. So if you have a well-diversified portfolio, you will still have some systematic risk just because it's the risk that from just being in the system. Beta is a measure of systematic risk and non-systematic risk, and probably a better way of saying it, beta is a measure of relative. I should have put that in, and I always want that in your definition on papers and exams, the word relative. It measures the relative systematic risk. So what we say is, this is really, really important, the stock market, the stock market beta is 1.0. So we start with our benchmark as the market's systematic risk, its beta is 1, and we measure every company against that. So a cyclical stock, it's one that has high systematic risk. It reacts very strongly to economic events. A firm like Ford Motor Company, when the economy goes in recession, cyclical stocks will have much, much worse net income impacts than other companies. So when we go into a recession, people are not going to buy cars because they're worried about losing their job. They're going to be cutting back on those big ticket consumer discretionary type of products. And therefore they have high systematic risk, and therefore they have a high beta. So the stock market has, by definition, a beta 1. So Ford might have a beta, let's say, maybe it's 1.8. 80% more systematic risk than the typical stock in the market. That's why I say it's a relative measure of risk. Then you have defensive stocks, a stock like Kroger's. We know right now with the coronavirus that, boy, Walmart, H-E-B, Kroger's, firms like Campbell Soups, Clorox, these firms that sell consumer staples, boy, they're doing extremely well right now because people are rushing in. You can almost say they're counter-cyclical, although they don't always react like this in every event. But when the economy goes in recession, these firms tend to do much better than other firms. And so what we say is they have low systematic risk. Our Kroger's might have a beta. Let's say maybe it's only 0.6. Their systematic risk is 40% lower than the typical stock, and only a third of that of Ford. So if you looked at the stock market right now and I would do it, but unfortunately the internet is down here while I'm doing this recording, so I can't show you. But you could look and just see how Walmart stock has done um, since mid-February versus Ford or versus the airlines especially, and the cruise lines. Now, obviously, there's some risks that are, like coronavirus is specifically hitting the travel industry harder than anybody else. So obviously they're doing very badly. And the coronavirus is actually causing people to run to Walmart and buy as much stuff as they can. So it's actually helping those stocks. So there are some special situations where you have certain systematic risks that specifically hit certain industries more than others. We know oil prices are down and gasoline prices are down. So Valero stock has done particularly badly the last 6 months. And that's one of the problems with beta is beta just has a one-factor model, but certain companies are exposed to certain systematic risk more than others at certain times, and so beta can be a very unstable number. And we'll see that one of your homework assignments when your Excel applications is to actually calculate the beta of a firm over time just to see how it's changed over time. So very important concept. Beta is a measure of the relative systematic risk of an individual stock, where the stock market's beta is 1, so every other stock's their risk is measured in relation to 1. If they're above 1, they're a cyclical stock. If they're below 1, they're a defensive stock. So that's systematic risk. Unsystematic risk that's the risk that is specific to the individual firm. It's also known as diversifiable risk, even idiosyncratic risk. You'll hear these different terms. And the wonderful thing about unsystematic risk is that it can be easily, very easily and very inexpensively completely eliminated. Not just reduced, not just managed, but simply, totally and completely eliminated. Just through diversification. This company-specific risk or idiosyncratic risk, you can completely eliminate it in your portfolio by just having several stocks in your portfolio. In fact, somewhere around 25 to 30 stocks, unsystematic risk completely disappears from your portfolio. You don't have any of it, and it's very easy to get rid of it by simply you could go to a like Vanguard.com, a mutual fund company, and buy one of their all U.S. stock index funds. If you did that, you'd have almost essentially every stock in the United States. You would have no unsystematic risk at all. It'd be completely eliminated. And buying a Vanguard mutual fund is extremely inexpensive. Their funds have very low fees and they're very easy to buy. It doesn't take much time to set one up. And so key to this risk, unsystematic risk, since it's so easy to get rid of and it doesn't cost you much to get rid of it, what William Sharpe says is you should not be compensated for taking unsystematic risk. The market's going to assume that you have a well-diversified portfolio, so why should you be paid for taking on a risk that is so easy to get rid of? Whereas you should be paid for taking systematic risk because you can eliminate it. Anytime you get in the stock market, you will have systematic risk. So what William Sharpe says is you'll be paid for taking systematic risk, but you'll be paid in relation to how much systematic risk you have. If you have a portfolio with a lot of high beta stocks, then your expected return should be higher, but you also have higher expected risk. If you buy a lot of low beta stocks, defensive stocks, your expected return will be lower, but also your risk will be much lower. You won't be so sensitive to economic swings. So we should be paid for taking systematic risk. William Sharpe also refers to systematic risk as the relevant risk. It's the risk we care about. We should not be compensated for taking unsystematic risk because we can so easily get rid of it. So I have Toys R Us as my example of a firm that no longer exists, essentially. It's going out of business. But if you had a firm that sells toys, maybe it could have a fire at a warehouse, or maybe it's not doing well, some new product is not working. But you could you could definitely have other stocks in your portfolio that are just getting good news at the exact same time as Toys R Us is getting bad news. So maybe you have Amazon in your portfolio and Toys R Us. Toys R Us goes out of business. Why? Well, because Amazon's taking over their business and is beating them competitively. So one of your stocks crashes, but the other one's up 30-40% on net, you're okay. Your portfolio is balanced. Now, if the Federal Reserve does something, that could make both Toys R Us and Amazon go down because people are worried about a recession. So diversifying your portfolio is not going to protect you from the Federal Reserve taking action, but it will protect you from some specific event at a specific company. I need to change my company example in my notes. All right, so total risk of a stock is very simple. It's just, you probably have had standard deviation. We've talked a little bit about it, but standard deviation, total risk is measured as a standard deviation of the stock's price. So you just take the change in the stock price over time and take the standard deviation of that, and that tells you the total risk of the stock. So total risk equals, see that equals, total risk equals systematic risk plus unsystematic risk. So what do we care about? Total risk, systematic risk, unsystematic risk. William Sharpe argued that if you're doing a public stock that's part of a well-diversified portfolio, systematic risk or systemic risk is the only relevant risk. Why? Because you can get rid of unsystematic risk very easily. Since you can eliminate it for free, the capital markets will not compensate you for that risk. So what he's saying is the only risk you should care about when you're trying to value a stock is systematic risk as measured by beta. Systematic risk is the only relevant risk to price into a stock's value. Beta is unbounded. It can go negative. It can be as negative as you like. It can be a huge positive number. You can have a beta of 5,000. You can have a beta of negative 64,000. The beta of overall market is 1, as we said. And so higher than 1, you're a cyclical stock. Below 1, you have a defensive stock. So when you're choosing your discount rate to value a stock, CAPM says the only factor that distinguishes one stock versus another is beta. So the capital asset pricing formula takes the risk-free rate plus beta. So you can see if your beta of your stock is 1, then the return on your stock should just be the return that you'd expect on the overall stock market. If you're forward, your beta is 1.8, you're going to add 80% more to your risk premium, and so you would expect or require a higher return on forward than an average stock. And if you're doing Kroger, where your beta is very low, like 0.6, then you're going to reduce the market risk premium. You'll reduce it by 40% if you use a 0.6, and so your required return for Kroger would be much lower. So you can't just say, wow, Yahoo has a high beta because it's a volatile stock. It's possible for a stock to be volatile but have a low beta. And that's because beta only measures systematic risk, and systematic risk is only usually about 20%, maybe 15 to 25% of the risk of a stock. It's hard, but most students struggle with this. How can that possibly be true? But for most stocks, probably 70 to 80% of the risk is unsystematic risk. So that means when you put a stock into a well-diversified portfolio, 70-80% of its risk just completely disappears. It's a wonderful thing. Now, in crises like we're having right now, that's not true. Stocks tend to move more together in a crisis. So unfortunately, stocks tend all move together more in a major crisis. In normal times, though, most of the stock's risk will disappear when you're in a well-diversified portfolio because most of the stock's risk is unsystematic risk. It's very easy to get historical betas. I would show you one today if the internet were not down. But a historical beta, if you go to Yahoo Finance and enter the ticker of a company, of a stock, you're going to do this in your Excel application on beta. You pick a company. When you enter that company on the Yahoo Finance will give you a beta. They keep changing how they forecast beta, and so in our next session, I'm going to show you how to do a rolling beta for your Excel application. Well, maybe not the next session, but pretty soon we will. And in doing that, you'll have a number. Your very last number should be the same beta that's shown in Yahoo Finance for your company. You'll notice in Yahoo Finance, boy, I wish I could show you, but you'll notice in Yahoo Finance that they say beta is 5 years using monthly data. In the past, they did 3 years using weekly data, so you'll see some of my beta videos on YouTube use 3 years weekly. Then they switched to 3 years monthly, so then I switched to 3 years monthly. Now they do 5 years monthly. And so that's what I'll do for you, is just so if you do the same calculation Yahoo Finance is doing, then your very last calculation when you're doing the last 5 years should be very close to what Yahoo Finance shows. So hopefully the internet will be up when I get to that one. That's why I'm not sure I'll do it next video or the one after that, because AT&T says the internet is going to be down for some time here. So it's very easy to get historical betas, but historical beta is not what we're using. I know a lot of classes teach to use a historical beta, but we actually want to use a future prospective beta, a beta that we expect going forward. So if you use what's in Yahoo Finance, you're just getting the beta they actually calculated for the last 5 years using monthly data. But when you do your Excel application assignment, you're going to calculate a beta for your company on a rolling 5-year basis. So you'll see how the beta has changed over time. And one of the biggest problems with the capital asset pricing model is that betas are very unstable. They go up and down really dramatically. And some people have said that that means you should kick out capital asset pricing model. It doesn't work. My argument is it works. Beta is very volatile, but I do think it's a really good conceptual way of thinking about risk. The only thing is you just can't use the historical number. You've got to have a prospective number. You've got to forecast beta. And so I'm going to show you how to do that here next. So this is one of my famous quotes. Beta is not a number you look up in Yahoo Finance. Beta is a forecast. Now I say Yahoo Finance is simply what beta was the last 3 years. They just recently changed this, and so now it's actually the last 5 years. I don't know why they changed it. They keep changing it. This is the third time they changed it. There was actually one point in time in history where the beta they were showing for companies was simply wrong. Someone had made a miscalculation, and so the numbers they were putting on their system were just wrong, fraudulent, and they were obviously wrong. They were so far off, and that stayed like that for several months. So I don't know who's in charge of beta in Yahoo Finance, where they're getting their data, but they've had some problem. All right, so here's what you have to do. One of your Excel applications, and I'll walk you through one for a company that I will pick. You have to pick your own company, but I'm going to walk you through for a company that I will pick and show you how to do the analysis. And there's 4 steps you have to do for your company. The first one is related to your revenue sensitivity. That's where you're going to decide whether your company is cyclical or defensive. The next 2 things relate to leverage. We're going to talk about operating leverage and financial leverage, and I'll show you how to do that. I actually have a spreadsheet that you can use to help you with that. And the last thing is what I was talking about with the rolling beta. So here's a video that shows you how to do a rolling beta, but the problem with this is it's doing it at this probably I can't remember, it's probably 3 years using weekly data. So I'm going to do another one for you using 5 years using monthly data, so it will be exactly what you have. And I have to look at the Excel application. I might have said 3 years monthly on the Excel application, but we'll change that. So you do it exactly how it's done in Yahoo Finance. That way, when you do your calculation, you will have at least one number to check against Yahoo Finance. So let's leave it there, and what we'll do next session is work through an example of calculating beta.